This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing Podcast. This is podcast number 133. It is the 7th of August and it's just gone 6:30. Today on this podcast, it's me, Peter Higgins, at Conquest3 on Twitter, and I'm here with my good colleague, Henry Viola here. You can find him at HT Viola on Twitter X. Not sure we'll be calling it in future because of what's been going on Twitter, but we'll talk about all the other isms and schisms and all the rest of it a bit later in this pod, because I know most of you have come back here to have a listen to the pod for investing purposes only, and you probably had enough of all the other political machinations and I nearly said a word I shouldn't have said then, but difficulties we've been having over the past few days. But we'll talk about that a bit later on. Henry, how have you been, mate? How have you been navigating the swamp of geopolitics and manoeuvrings over the past few days?
I'm very well, thank you, Peter. I've had a really interesting couple of weeks since we last spoke, portfolio-wise. I imagine most of our listeners will have noticed the incredible volatility we've had over the last couple of days, particularly with the Japanese market. I think it started out in the US with a jobs report that came in slightly below expectations. And that then seemed to kickstart ructions over in Japan, which I think the Japanese market dropped something like 12% overnight on Monday night. So I woke up to headlines of, oh my gosh, the stock market's collapsing, everybody run for the hills.
Armageddon.
So it's been an interesting couple of weeks.
Yeah, I mean, this is the interesting thing about the markets, and I always say to people, you know, if you're investing long term, a difficult Friday or a difficult Monday doesn't make a year. You know, a fantastic Friday or a fantastic Monday doesn't make a year, doesn't make a decade of investing. So you should always take the positives and negatives of the volatility of the market with a pinch of salt, you know. And on top of that, if you really think the markets are going to have a really difficult couple of weeks, prior to that, at any time in the year, take some money off the table and be ready for the opportunities that the markets will give you at least twice a year. You know, where the markets go oops and take a little bit of a nosedive for whatever reason, and use that as a buying op if you're so bold. You know, because people are coming out on Monday, yeah. I'm losing track of the days. We're on Wednesday. People are coming out on Monday saying, "Oh yeah, I sold all my portfolio. I sold 50% of my I've sold X, Y, and Z of my portfolio." They're telling people on this on Monday after the market crashed on Friday and went lower in the UK again on Monday. Now, I'm the sort of person that thinks that, you know what, if you're going to share something consistently, share it consistently. Yeah, but don't be telling people what you've done on Friday when the markets have absolutely been pummeled on a Monday, because it doesn't help. It doesn't help anybody.
Absolutely.
You know? Say again, sorry?
Absolutely. I mean, my last article I just published on my blog was all about how to handle this sort of volatility. I've just published an article about portfolio diversification. So when the market started going bananas on Friday, it was sort of a passing curiosity for me, really. I picked up my phone and went, oh, look, the US market's gone a bit janky. And then again, when I woke up on the Tuesday and the Japanese market had gone a bit janky, I wonder if there's a buying opportunity there. I wonder if the market will throw up any goodies. Whereas an awful lot of people seem to be thinking, no, this is the beginning of an enormous crash. We've been predicting this for years. Everybody needs to sell absolutely everything they own immediately because it's all going to zero tomorrow. Sure enough, that Japan trade bounced. So the Japanese market skyrocketed the day after it fell. And that was caused partly by something called the carry trade, which I wanted to talk about on this episode.
Go for it. Talk about it now, Henry. We can go back to what the FTSE did on Monday and where it is today in a minute. If you want to go there directly, go there.
Yeah, I mean, it really interested me, this, because I'm quite an ordinary investor. I tend to buy regular equities and I go long on them. I don't short, I don't hold derivatives, I don't do binary options or anything like that. So when I heard the phrase carry trade, I thought, well, what is this? And effectively, what's happened, you've had a load of investors over in Japan that for 10, 15 years haven't been able to get any interest on their savings. The bank base rate has been rock bottom. It's been sort of 0.25% or something. And as a result of that, not only have they not been getting any money on their yen denominated savings account, but they could also borrow yen incredibly cheaply. You know, you could sort of borrow yen for 10 years at 2% or something bonkers. We've had something similar over here with the pound, and I think, you know, the dollar as well has had a period of low interest rates. But what effectively was going on was that you've got a large number of investors over in Japan that had been borrowing yen and then using them to buy foreign currencies. So they go out and they buy dollars, they buy pounds, they buy euros, etc., in countries that have got higher rates of interest, and they invest those currencies in investment opportunities that have got a better return profile, shall we say. So back in early July, it cost a Japanese investor about 200 yen to buy a single pound of assets. So you got 200 yen to the pound. But by August 6th, each pound only bought you 180 yen back. So you were 20 yen short. If you'd gone out and borrowed 200 yen, used it to buy pounds so that you could buy, say, the FTSE 100, when you then needed to repay that loan, you only were getting 180 yen back. So where do you get the shortfall? Because you still owe that money. You've got to make up the shortfall from somewhere. So that then caused
margins, mate. Yep.
The investors then go and they sell Japanese yen denominated assets to make up the shortfall that they borrowed. This absolutely tanked the Japanese stock market. Volatility went through the roof. The VIX skyrocketed. That's the Chicago Board Options Exchange Volatility Index, I think it's called. It's basically a measure of volatility in the markets. This absolutely skyrocketed. And there are a whole swathe of financial derivatives that are based off that VIX level and what it's doing. So those all went bananas. Because volatility skyrocketed, loads of hedge funds and pension funds start to sell assets because they want to reduce their exposure to the markets. That then started tanking broader indices. Next thing you know, you've got a market out because some guys in Japan have borrowed some yen, basically. Sure enough, when the market figured out what was going on, and it didn't take long, people realized, hang on a minute, the Japanese market's been totally oversold. It's actually in quite good shape. And the Japanese topics went up about 10% the day after falling 12% the day before. So it made up nearly all of its gains.
Brilliantly explained, mate. It's something that's been going on for ages. They've used property for it historically, haven't they? I think before they were using the yen, and that didn't work out so well for a little while. They had a few little implosions there as well, and unfortunately, it's going to be something that carries on going forward. And they're going to have peaks and troughs with this. Sadly, there's going to be some more hedge funds coming out in the next few days saying they've imploded. Yeah. And depending on what happens with the margin calls, I suspect you're going to see some US and UK institutions saying in their write-ups that they had a margin call on Friday or Monday in relation to that very thing, the carry trade. And we'll see more and more talk about it going forward, because I don't think that deficit and that margin call that they had on Friday and Monday of this week, that all of them were able to offset it.
No way. Well, effectively, you've only had, I think it was a 0.25% rise in base rates in Japan at the same time as you had a 0.25% cut over in the US. So you've only had 50 basis points of movement between the interest margin. there's still
it's
quite a big margin.
It's the leverage, mate. It's the leverage times 10, times 20, times 100
exactly.
times. All this stuff that they said they'd never do again. Yeah.
And they're back doing it.
After the financial crash is being done again.
Yeah.
Yeah. So
but
yeah,
when you understand those mechanics, I think it's a little easier to stay calm as an investor, you know. And if you've got your portfolio set up the right way, you've not overweighted towards really risky things, you've not got loads of leverage, you've not got derivatives that you don't understand, you can sit there and take your time and go, well, hang on a minute, is the Japanese market really worth 10% less today than it was yesterday? Why? If you can't come up with an obvious reason, odds are, you know, good chance it's derivatives or something like this, some sort of financial mechanics going on in the market that's causing the volatility spike. And sometimes if you just sit tight, it's all fine.
Absolutely. I think the other thing you touched on earlier was the talk of, crikey, the US is going to go into a recession, was the talk on Friday. Media hype, pushing that narrative on Friday, and over the weekend ensued panic, you know, which led to, and I'll put the numbers up in a minute, for the FTSE on Friday and then on Monday, and everything got hammered. You know, everyone was just completely like, the end is nigh. And you know, I was saying I was concerned about the markets. The couple of podcasts before, I was saying if this doesn't happen, that doesn't happen, we could hit 8,000. On Thursday, I had no inkling, no thoughts whatsoever that we would see 8,000 on the FTSE 100. I had no reason to think that was going to happen. I read almost everything I can. I didn't see it in 8,000 at all. But there you go. One bit of news. We had GDP going to be popping. Couple of chats before from America, and then Friday come out. It's going to be a recession because that data says that. What's changed in the past 4 weeks? Yeah. And then wallop, the market gets absolutely creamed. So let's talk about what happened to our market here, mate. So we've got Friday, we're down X amount of percent, right? And we finished 8,100 and odd on Friday. Monday, we open up after getting, you know, all the panic, all the media telling us that's it, it's over. Yeah, we're going to hit a recession. America's going to hit a recession. The UK is going to catch the US's cold, and we're going to get pneumonia. Yeah, and within hours of opening, the FTSE 100 hit a low, Henry, of 7,915.
Not good.
That's how low it went on Monday morning. Luckily, we had the bounce, a little bounce back in the afternoon, because the US market didn't continue to implode. But all markets were down on average 2+%. FTSE was down 2%, 166 points, closed at 8,008 points. FTSE All Share was down 2.16%. This is on Monday we're talking, folks, remember. I know you don't want to be reminded of it, by the way. I appreciate that. I'm just being chronological with my numbers here. And FTSE All Share was down 2.16%, 96 points at 4,377. FTSE AIM All Share gave up the ghost on Friday already, and was down below 800, and it went down a further 2.94% on Monday at 748 points. That's how much that got absolutely whacked. And then we had what essentially was the calming day on Tuesday. Yeah, after the little bit of recovery on late afternoon on Monday. Calming day yesterday. Markets had a bit of a reprieve. And then today we're up 1.75%. We had a low today, the FTSE 100 of 8,028 and a high of 8,176, and it finished at 8,166, just 10 points shy of its intraday high. And the market was up 1.75%, 140 points up today. FTSE all share was up 1.64% at 4,462. be nice to see that above 4,500 tomorrow. Carry on the momentum into the latter part of the week. FTSE AIM all share was up 1% at 767. So again, trying to recover that 800 support level that it needs to hit. But it's been absolute mayhem, and people coming out saying the end is nigh. I've sold all my portfolio, and the market's recovering as such. Some people say, look out, Pete, it could be a dead cat bounce. It could well be, but I don't see the market as some people do, in the sense of we are now heading for a recession. The US is now heading for a recession. Historically, in the year where there is an electoral race in the US, the markets tend to do well in the latter part of the year, historically. Those with almanacs can go and have a look and see what's been said about the last 3 months of most electoral years. And also, as we know, we tend to have, if we have it, and no one's gone out and rioted against Santa, we tend to have a rally at the latter part of the year as well. So I'm still in the camp that we'll be okay. The summer's always difficult because we have lower volume, and then therefore increased volatility. I wish I'd said it, but I didn't. But sometimes you need to take out some insurance. Buy the VIX, as Kramer would say. It was down at 12.13, I think, on Friday afternoon or Monday, whichever day it was. It hit 60. Yeah. When it's below 15, start buying incremental positions in the VIX. Yeah. And then when the market has a wobbly and it goes to 30 and above, sell the VIX. Nice, easy money to be made if you want to trade. Did I do it? No. Have I looked at it loads of time? Yes. Yeah. But I haven't done it. I tend to just buy my stocks, buy my quality stocks, and then do a little bit of stuff in around the margins that I fancy, and occasionally do the odd trade. But other than that, I'm looking for my stocks as always, intrinsic value stocks. And what happened this week? This week got absolutely chinned, Henry. Yeah, I talked about my takeover with Wood Group. It'd been going, it'd been extended. I saw what I thought was a tell on it. Hit 213, then it didn't go above 213, bearing in mind that the bid was at 230. And Sidara had asked for an extension, got an extension till August the 9th, which is Friday. And on last Friday, the shares were still there hanging on to £2. And I thought to myself, next week they'll come back. I'd already trimmed off, taken off as much as I wanted to secure the lock-in for the takeover. I thought, after all these extensions, they're probably going to come back. I'd already taken some off the table just to edge it. But no, saw the violence on the streets, saw the recessionary noise in America, the impact of this and the impact of that, and used that, I think, as an excuse to walk away. And the share price tanked. I was still holding it. I'm not going to tell you on this show that I actually sold them, because I didn't sell them all. I still had them. Yeah, I'm the loser. Yeah, I know. And the shares was down 40%, mate. Yeah, they hit £1.8 in a single move, mate. On Monday, they went from £2 odd, yeah, to 118.
Oh,
and I was sitting there going, such is life.
Oh,
yeah. I looked at it on Monday, yeah, and I thought, 120. Converses 230 buy. Let me just sit and wait this out for a few more days. Yeah. Didn't buy any. Not going to tell you that I did. I didn't buy the bottom, folks. Today it closed up at 133 versus the £2.30 takeover. Have I bought any more yet? No. Just watching, just waiting. I bought at 130 odd in the first place. Yeah. Took loads off the table at 210. Now I'm just sitting waiting. I'm in no rush.
But that's the thing about the risk management. I mean, one thing I've always quite liked about your approach is that when you get these takeoffers come in and they're announced and the share prices spike, you nearly always sell into that spike. I don't think there have been many takeovers out of your 55 or whatever it is that held all the way through to the shares being delisted and getting cash in. You tend to sell into them, which means that of the handful that do fall through like this, actually, the money's off the table. So you've benefited from the takeover talks, or in this case, an actual offer. And then you've not got the risk if it falls through. Whereas I did the opposite. So on dark trades, nearly all my takeovers I've held through to completion. Dark trace was one that went wrong the first time round. Takeover offer came in. I thought, whoop-de-doo, I'll just leave it be. And then the buyer walked away and the shares fell. And it took me another year for another offer to come in and eventually, go through. And that second time round, I took a leaf out of your book and I thought, you know what, I'm going to sell into the rally this time. I'm happy with the price I've got. I'm a couple of pence off the deal price, de-risk it.
Yeah, and sometimes you just have to do that. And this is the second time it's happened, by the way, to Wood Group. So I'm not sure what it is about them and luck and all the rest of it. And these takeovers are the intrinsic value might be there, but it's luck if somebody comes and actually bids, because these companies can stay undervalued forever. Yeah. But it's currently sitting there at 133-ish or whatever it finished today. I haven't bought any more yet. I'm waiting to see what happens and what they come out and say with the next update. And Sadara can't do anything now for 6 months, but others might approach them. But if they come out with some news and say that actually we're not doing very well, share price goes lower.
Yeah.
But yeah. Some on watch list. I want to speak about a couple of stocks on my watch list a bit later on, but I'll be adding at some point. I haven't added yet, but obviously still in profit from where I bought it before. But that's where it is, Henry. The markets are volatile. Henry and I are still learning. We do not know it all. We don't sell at every top. We do not buy at every bottom, and we don't tell people what to buy or sell. We're just here to try and share information and share.
More often than not, I buy at the top and sell at the bottom. No, I'm joking.
That's me. That's me. That's me. But as I said to you before, and Henry just said it earlier, we're not here trading stocks. We're not trading options. We're not leveraging everything. So if one of our stocks get impaled, like Wood Group did for me on Monday, I'm not running out or trying to kick someone else's cat, because I don't have a cat in the house. But I'm not losing it because one stock's been impaled by 40%.
No animals were harmed in the filming of this podcast.
Neither am I running around the streets cheering that I'm the daddy because I've had a takeover because it's gone up 40%. You've got to take the good with the bad. You know what I mean? And you've got to think, folks, long term. Friday and Monday did not make or break your portfolio, or it shouldn't have done. Unless you've got 4 stocks and they all went down 5% each, or 10% or 20% each, or had a massive profit warning on Monday or Tuesday or Wednesday of this week, and you've only got 2 or 4 of them. Which goes back to Henry's article, about diversifying and the values of. I've got to say this, and I did write you a tweet, Henry, as well, about the article, which was a brilliant one, by the way, mate. I'm not just saying this because you're on the podcast, because you know me. If it was SHIT, I'd probably tell you, because I'm a nice guy like that. But it was a genuinely good article.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe, and you'll always be the first to get the new episodes. Thank you for your continued support.
But the beautiful thing you said about that article, within that article, was also about, this is almost a different reference to carriage trade, but if you're trading that often, right? Yeah. If you're diversified and you've got 40 stocks and you're trading them in and out, blah, 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 you're accruing a lot of costs over the course of a year. Even if you're paying £5 each and you've got a 40 stocks in your portfolio and you're doing 20 of those backwards and forwards. How much is that? Yeah, that's £1,000 a year. Yeah. Times that over 20 years, right? How much would that be worth if you kept that in your portfolio and compounded it at 5%? It's a staggering amount of money. I see so many people saying that they're investors when they're trading every single day, trimming and selling and buying. And traders must be doing, I know traders that are doing 20, 40 trades a day, but they only tell you about the three of the ones that they've won on. You know what I mean?
It's
tell you about the losing ones.
It is truly unbelievable. I mean, let me see if I can find the figures. Because I don't.
I think you were using £200
Yeah.
We compounded it at 5%, and it amounted to 26 grand over the course of 20 years.
So let's say you can trade all in for a flat fee of £5 a trade, right? £5 in, £5 out, you know, including your stamp duty and all the rest of it, right? That would cost you, let's say, £200 a year in fees if you've got 40 individual sets of trades, so a buy and a sell pair. If you invested that money at just 5%, and I'd like to think that most of our audience can generate more than 5% a year annualized. If not, you're probably better off with an index fund, but that's a conversation for another time. Anyway, if you invested that at 5%, it'd be worth 329 quid after 10 years, or 541 if you manage to get 10% a year on it. Now, that doesn't sound like a lot, but imagine doing that £200 every single year, right? So you don't just put 200 in at the beginning and then never touch your portfolio again. Imagine you're spending £200 a year on your trading costs. Now you're spending £8,000 in trading costs, or £26,000 if you invest it at 5%. You know, you've cost yourself a new car, you've cost yourself a lifetime of holidays just by clicking that buy and sell button at £5 a go.
Mate, 26 grand is not a lifetime holidays anymore, mate. I've been looking. I've been looking. It ain't 20. It costs you 15 grand for a good holiday now, mate. 12 grand, trust me. But yeah, you make a good point. You make a good point. 26 grand's a lot of money.
It's a big chunk of change,
especially in this current environment.
That's the thing, you know. You can't just think about it in terms of, oh, it's just £5 or £200 a year that I'm spending, because that on its own, fine. I'd like to think most of our audience could afford the £200 really without batting an eyelid. Yeah. It's what happens when you spend that every year over 10, 15, 20 years, and what would have happened if you'd invested it and generated a return on it. That's where the real damage comes. So, yeah.
Absolutely. No, great article. Right, where do you want to go next, Henry?
Well, for me, I think talking about watch lists and, you know, opportunities in the market, I just wanted to talk for a moment about what sort of types of companies I'm looking for.
Right, okay, go for it.
So, you know, we briefly talked about different metrics for measuring companies, things like return on capital employed and return on invested capital and profit margin and operating margin and revenue growth and so on. But when I was building my watch list, I came at it from another angle. I didn't start with looking for the quality. I actually looked for things that I didn't want to invest in. So
want to. You're doing the reverse. What do I want
exactly.
to avoid? Okay, I like that. Okay.
So the FTSE all shares got, I don't know, let's say 3,000 companies on it or whatever it is, right? I can't possibly go out and look at 3,000 companies. I'd be doing nothing but reading annual reports all day for the rest of my life. So I need to start discounting things. So the first thing I started looking at was sectors that I definitely don't want to touch, or types of business that I definitely don't want to touch. In my case, I go on about retail a lot. I've got a terrible track record with retailers. I don't understand them. I can't predict their future returns. I find them hugely volatile. They're in favor 1 year and out the next. So I discount the retail sector. I'm not a big fan of tobacco stocks. You know, if you want to go out and smoke, fine, crack on with it, but I'm not going to invest in a company that will facilitate you doing that. I don't particularly like gambling businesses, so they were off the list. I wasn't a big fan of oil and gas companies. Again, I've talked about that before, so they were off the list. And I started to exclude sectors. So when you're on a platform like SharePad, and you're building your list, you can set criteria. And so the very, very first criteria I put on my stock screen was actually that the sector excluded these different types of businesses. So you can exclude the retail sector, you can exclude the oil and gas sector, you can exclude mining companies and whatever else. And so by doing that, these 3,000 shares start to get whittled down. Next thing you know, you've got 500 and then 2,000 and then 1,500.
Yeah.
And it was only then that I really started looking at businesses that I was trying to find the most high quality businesses, but again, I came at it from the reverse angle. So I thought about what a low quality business might be and tried to exclude those. So I filtered for things like companies with a return on capital employed of less than 10%. So if you're either raising equity or raising debt and you can't generate more than 10% on it, odds are you're probably generating around the return, around the cost of capital it's costing you to raise that money in the first place. You might even be generating less. Very little margin in the business, so I probably don't want to invest in that sort of a company. Companies that have got slim operating profits, again, I've got a benchmark figure of 10% operating profit that I like to see. If you can't generate less than that, sorry, if you can't generate more than that, it doesn't mean that you're an unprofitable business. But again, you're not an outstanding one necessarily. And these were the sorts of metrics that I started looking at. So rather than trying to find the very, very highest quality all the time, I was trying to exclude the ones that that were low quality. And by doing that, I then managed to get down to a watch list, a screen, I should say, rather than a watch list of a couple of hundred names. And out of those, I then started looking for characteristics that I really liked. So everybody knows I love my dividends. I love yield. So I was looking for high yield businesses, and then I started looking at dividend cover. I started looking at debt, trying to find companies with low debt, trying to find companies that have got growing revenue and growing profit margins historically. And then I took it a step further after that and started looking at forecasts, because for years I was always looking at the historical figures.
Yes.
Came across
historic, as in that's what happened in the past, Henry. Doesn't mean that's going to happen in the future.
You've got it. I made that rookie error. So anytime you walk into an investment,
everyone makes that error. Always done. It's compounded that for three years. It's up 100%. It's going to go up another 100%. Not necessarily.
It's more likely to fall.
All done it. We've all done it, mate. All done it.
But that was kind of the way I started tackling my watch list, and it ended up throwing out some super interesting names. And then from there, you can really start researching these. So this is where, when I start throwing names out on the podcast for research, these are names that are on the watch list. My watch list's got 100, 150 names on it, and I'm going away.
That much?
Yeah,
that's a lot, mate. It's a big old watch list.
Yeah. Because a lot of them, when I'm researching them, they never go near my price target, or the revenue starts to decline, or the operating margin starts to decline, or the balance sheet goes wrong, or all sorts of things happen with some of these.
That's the eye-watering amount, mate. If I can be so bold, I'll be saying carry on filtering that down a little bit.
Keep filtering down, you know exactly.
Because my question to you would be, from that 150, what's your trigger to say, oh, that one's happening now, so therefore I need to look at that one closer? What happens there? Of that 150, let's pluck a stock out of the air, Experian. When does that jump out and you say, actually, now I need to get close to buy? What do you see? What does SharePad tell you, or what happens?
So for me, it's a very, I'm going to sound a little bit like Wheelie here. It's a little bit of this and a little bit of that.
That means F all to me, mate.
Right. So, no, what I mean by it, there are lots of different triggers I've got. So things tend to make their way onto the watch list, either because I know that they've got characteristics that I like, or someone's told me something about it that I like the sound of. So the Twin Peaks Investing podcast, before I was on it, you and Wheelie might throw a name out, and I'd want to keep an eye on that. But a catalyst for looking closer would be a sudden change in one of the metrics. So if the operating margin suddenly shifts, or the revenue suddenly spikes.
With that. Yeah, with that.
And I've got a screen set up to watch the news on the watch list. So in addition to reading RNSs in the morning that are to do with my own portfolio, I'm also reading RNSs on the weekends and evenings that are from the companies on my watch list. And a lot of them you can now get on YouTube. There are channels that do investor relations presentations from companies.
Yeah.
And when they have a results update, there's often a presentation that goes with it. And so when I'm doing the pots in the evening, or I'm cooking the chicken or whatever, I'll have one of these on in the background, and I'm listening to it, and I'm absorbing the information. And sometimes I'll hear something that I really like the sound of. The company might have been on my watch list for 2 or 3 years by this point. I've never really looked at it too closely, or it's not really fitted the criteria for a buy. But all of a sudden, something's piqued my interest, and then I'll start doing a deep dive on it, looking at the competitors, looking at the history of the business, looking at the management team and what they're doing. And then I'll start to go and really try and get as much information as I can on it. How many investor presentations can I watch? How many annual reports or interviews, or what's on their website? What's on the news updates?
Yeah.
And really
Mate,
trying to build a picture.
love that. Love that. Love that. Makes perfect sense to me. 150 still a little bit. I feel like I'm bench pressing my weight of and the rest of the people on the street I live on. But yeah, that's the way to go about it. I mean, that's part of the. I mean, there's two reasons really. I do the bullish RNS stuff in the morning where I put out X amount of stocks, which I think would do reasonably well, is to give people the opportunities because they don't get the time to look at all the different stocks that are out there. But on a daily basis, I put out what I think is a bullish RNS regarding stocks that have outperformed. I've come out and won some contracts. I've shown a large increase in profit before tax (PBT), etc., etc., and got some commercial deals that people didn't expect. So I'm looking back on my list for last week, Henry. Yeah, and they were of the ones I plucked out X amount each day. Had 79 stocks that were winners, that were up, yeah, more than when they started the week, right? And there was 37 that were above plus 5% across on that one day alone that they came out with that RNS feed, right? And KRS was a stock last week. It was up 42% on that one day of the 1st of August on a commencement of a commercial production at Delta, one of these other places that they're doing. MKA was up 30%. And one of the ones that everyone went, not going anywhere near that. It's an absolute stock. Not going to ever buy that one stock. You know what came in third last week on one day?
Well,
Yeah. On the 30th of July, St. James's Place went up 24.8%
yes.
on that little tweak in expectations. Things have not continued to go bad. We're trying to sort it out. We're going to be doing this, doing that. Bang, up more than 25% in a heartbeat last week. And this was a stock that no one wanted.
Yeah.
Yeah. Nobody wanted it at all. And it went up 25%. Everyone's looking, going, what did I miss?
Yeah. The shorters were crying.
Well, yeah. There is that. And I think on Monday there was two. I only had two stocks on Monday that actually went up. From my list. I'm trying to find it. Two really obscure ones, but they're up 70% each on Monday when everything else is being sold off.
Yeah.
Yeah. So yeah, just keep. But RNS is the way. I mean, I keep saying this to people. Please just read the RNS. Please read the detail of the RNS because the opportunities are there, and you see the catalyst beginning. Don't just look out for a company that says, "Oh, it's ahead or slightly ahead." Have a look at what the companies are saying within the last paragraph about what that you talk about, what they're saying about what's going on in the future. What does it look like? What does the outlook look like? You know,
and that's the whole point of a watch list. You are watching these companies, so don't look at what they've already done. Look at what they're doing now and what they're going to be doing.
Absolutely, which is why I'm buying as close as I can near the bottom. I'm thinking, I mean, I'll talk about a stock in a minute, which I've got my eye on. You know, and right now, Wood Group, going back to it, it's down at X amount of whatever year low or 2 year low again. And I'm going, I'm just watching it right now. I've still got some, but I'm still watching it. Have I gone, I'm out of here? No. You know, there's a stock that I'm going to tell you about in a minute that I sold and I exited and I've watched. And you know what? It went higher. It carried on going higher without me. Got it in my watch list. It's come back to where I sold out. I want to be greedy. I want it to go a bit lower. And I'm going to be buying it again.
Yeah.
You know, but that's the beauty of a watch list. But what I have been doing, and this has got a lot to do with Algie Hall and Phil Oakley, is that the stuff I'm buying now is further and further and further and further up the food chain. Yeah, I'm buying stuff up there in the FTSE 500, FTSE 350. I'm not the speculative stuff. I can do that all day. I can just wait a year for it. Don't tell anyone about it. And then say here's a contract list that don't tell me anything.
Wait for the gold mine with no gold to find some.
No, not that speculative, mate. But by some of the parts intrinsic value stuff, nobody wants it.
Yeah.
Nobody wants it.
Yeah.
Yeah. So I'll keep doing that all day long. I can keep finding them. I've got a process now that enables me to use your analogy, dig for gold and find the odd gem. And you know what? I've got two more stocks, which I've looked at everything that's going on with it, and I'm going, them two are going to be takeover stocks in the next 4 months. At least two of them. Yeah. And this year I'll hit my 60th in 10 years. I guarantee it. I guarantee it. It's not about crystal ball in here. What's going on with those stocks and looking at and also it's a heads up for some people that are looking and thinking, how does he manage those stocks to be taken over? Have a look at what the hedge funds are doing and what they're buying. Right? Have a look at what they're buying, not what they're selling. Have a look at what they're buying. Have a look at who's buying and taking a stake in this company, that company. Who's increasing their holdings in that company, in those companies? What sectors is the most money being pushed into? Is it retail that Henry hates, right? Is it property that everyone's gone, no, not ever buying a construction stock or a property stock or a REIT again? Have a look at that, and that will tell you where, to use the old saying, follow the money. Follow the money. Yeah. What's being taken over in the US by certain companies at 15, 20, 35% premium? Because when that full priced in sort of metrics is done for the US companies in that sector, they're going to start looking at the UK, which is vastly cheaper.
Yeah.
Vastly cheaper. And that's what I've been doing. And then I do the numbers, do the crunching. Takes me hours. People's going, what a waste of time that is. I spent 2 minutes choosing my stocks. Well, you crack on doing that. Yeah. But two more. Got two more. And I'll be ready to show you the contract notes unless I've already released the names of the stock already. Henry, can we just have a break here, mate? Because we've had some despite all the SHIT that's going on in the world, we've had actually some very generous people come to the fore, came to your calling because you just absolutely said it with your heart and compassion about why we need to raise some money for this charity called Centrepoint. And people came out and actually supported you, mate. So let's just give them a big shout out, tell them where the numbers are right now, how close we are to 3K, and give out some names and what they actually donated, mate. Because I think we need to applaud everybody that actually came out and made a donation.
Yeah, totally with you, Peter. Huge thank you to the audience who have been incredibly generous since the last episode aired. Our Just Giving fundraise for Centrepoint is now sat at £2,912. We're £88 off 3,000, 58% of our target. It's absolutely wonderful. I mean, the episode went live and almost within minutes I've got people donating. It's massively appreciated, and I think it really goes to show that we've got a very generous audience, very kind audience. And yeah, I just wanted to read some of the messages out really because we've had some great messages. NBE, a worthy cause, and wanted to say thank you for all your efforts on the pod. £25 and £6.25 gift aid. Joe Ingham. Your message was moving and incredibly meaningful. It's my pleasure to support as always. £20 and £5 gift aid. Paddy Spud.
Well done.
And I think Paddy, he almost gets comment of the year for me with this one. Henry, could you possibly give me a spot on shout out? You absolutely can, Paddy, because you were spot on with your donation of £50 plus £12.50 gift aid.
Thank you, Paddy Spud. Yeah, I love that. He's a good lad.
Bit of a legend. And we've got another legend here, ladies and gentlemen, our friend Matthew Gregory. That's Matthew with one T.
Yes, you've got to get it right, mate. And he's done multiple donations, by the way, so thank you, Matthew.
He has multiple donations, multiple comments, always reshares the podcast. We are talking top tier audience member here, ladies and gents. If you don't follow him on Twitter, he is available on Twitter. Great character. Hope this helps a little bit. Love the show. Love the vibe of growth through kindness. I think the world could do with a bit more of that at the moment. Keep the shows coming. £25 plus £6.25 gift aid. We've had John McD. Great podcast, great cause. £25 plus £6.25 gift aid.
Thank you, John.
And the donations just keep rolling in. Pete S. Really enjoying the podcast. I've only been listening for a few months, but I found it really interesting. Wonderful charity to support. £25 plus £6.25 gift aid.
Thank you, Pete.
Thank you very much
for joining
Pete
us,
S.
and thank you for listening to the pod as well and joining us, mate. It's really great to have you on board. Thank you.
Spot on. If you are on Twitter, if you're on LinkedIn, please do leave us a comment. Let us know what you like. We always love to hear from our audience.
And YouTube. Don't forget YouTube and YouTube. Leave a message there as well if you want to.
David Liddon, just a little thank you for all the work you do for your selected charities. And finally, a donor called Michael. Just listen to your latest podcast with thanks. I'm sorry to hear no more donations to your chosen charity. Actually, Michael, I'm pleased to say that there was a bit of a stampede this time round, including yourself. As I can afford to invest, I can also donate a few pounds. Best regards, Michael from Ayrshire. £20 plus £5 gift aid.
Thank you, Michael. And thank you for everybody that's donated. That's absolutely fantastic what you've done over the past couple of weeks. And if you feel, that you can afford to donate, please do so, having listened to this podcast. And it's brilliant, mate. Very well done. You moved our audience as per usual, mate, with your eloquence.
Oh, I think it's a team effort, Pete. I think it's a team effort. But, if anybody would like to donate and hasn't done so yet, the page is available at justgiving.com/page/Twin Peaks Challenge 24.
Brilliant, mate. Very well done. Right, we're going to have a little break here whilst I talk about another stock. And this is a stock that's very close to my heart and close to the family's heart. Because my dad's got an absolute shed load of them. But the share price has not been very kind to him over the past year or so. And I've always said I'd never buy this company. Not because it's bad, a company, not because I thought it was expensive or any of those reasons, purely because my dad owns the shares, shed load of them. And he ordinarily has paid into a share save scheme where it was putting in 100 quid or 250 quid or 500 quid, I don't know what the number was. And it was for every 2 shares, every 1 share he bought, he got 1 free. So I'm like, that's half price, So there's no way I'm going to pay full price if he's buying it for half price. Ain't happening, right? But given the share price has gone from £100 plus per share, right? When he wouldn't take my advice to maybe trim some more, take some off the table, because he's getting a bounty of dividends, because he loves his dividends. He loves the little thing coming through the post, and he's going rubbing his hands together. Gone from £100 odd plus down to I think it was £40 last time I looked. Now 39-ish, because it's gone down a bit further. Yeah, everyone knows the company. Specialty chemicals company Croda. It's involved in all manner of different things, including food stuff and other beautifying products that lots of different people use. And it's now at £39-ish. And it's got a pipeline which has stagnated over the past year. That pipeline should open up, and there'll be some more catalyst and revenue generating, profit generating products coming to the fore in the next 12 months. That is so close to my buying price now, having gone from 100 down to sub 40. I spoke with my dad at the weekend about this. I went to see him, and he gave me that look as if in the eyes, just saying, "You little bugger." One of them looks as if saying, "You know what I mean?" I said, "Actually, you know what? I might start buying some now, Dad, for the first time in the 40 odd years that you've had."
He doesn't care about you getting a deal. He wants to know why he's lost all this money. Yeah,
mate, we've had that chat numerous times, and I've explained to him. But it is concerned now, and this is something that we've all, he is the age he is, late 70s, and he's like, he says, by the time these stocks return back to 100, I'll probably be dead. I'm like, don't be talking like nonsense like that. I said, look, if things happen in the next 6 to 18 months, we'll be back above 50, back above 60. If they come out with some cracking news and the catalyst got, who knows, somebody might bid for them 80, 90 quid to 100 pounds. Blah, blah. This is how fast things move. They're in negative. Sentiment is really against them. Everything's pushing the share price down. Yeah. catalyst, all of a sudden it's St James's Place getting a 25% pop in one day. Who knows? Otherwise, no catalyst. It stays there at 39, goes to 35, may even go to 30, but he's still getting his dividends while he's waiting. He's had bumper dividends over the years. Has he lost any money on the shares that he's got? Absolutely, categorically not. Is he happy about me possibly buying them at the same price, half price on average that he's probably bought them at? No, right? But the company's Croda, CRDA, and it's on my watch list. I haven't bought any yet, folks. I know a few fund managers that have bought it, got their eyes on it as well. That have spoken about it on the Investing Matters pod that I had on a panel on. One of the chaps is Charlie Huggins. I don't think he's bought it yet either. A super guy, smashing fund manager, wealth manager, and he's got it on his watch list as well. But that's one of the stocks I've got on my watch list. Keep an eye on it, and I think it would do well going forward. And I'm not sure if you've ever looked at it, thought about it, other than when I've mentioned it on here.
I remember you talking about this years ago, and I even remember where I was. I was walking home. It was back when I lived in Canada Water, so it's a couple of years ago now. And I remember walking home and hearing the story about your dad and this firm and how many shares he got and how it had done so well, and looking at it and thinking, wow, gee whiz, that's an expensive company. Good for Peter's dad. And now to be sitting here years later, it interested me at the time. If it's come down that much, that might be going on. That might be number 151 on my watch list.
I'm just pulling it up now, right, off SharePad. It went up today, just shy of 1%, up 38 pence, closed exactly at £39 per share. So it's sub 39 yesterday. Forward PE of 27.9. The 3-year average PE is still quite high. 3-year average PE is 29.4. Turnover forecast growth is minus 1.3% at the moment. And the 3-year average of that was 6.8. So you can see where and why the share price has come down and off a little bit. Pre-tax profits at forecast is 12.7. 3-year average is minus 4.3. So we're in the cusp of having a good year in the next 12 months, potentially. Forecast yield is 2.8, which is low again. So you're looking for that to be increased going forward. But yeah, I'm looking at the pipeline. I'm looking beyond what's happening this year, looking at the pipeline for 2025, 26. And I'm thinking, the FTSE 100, FTSE 250 company that potentially I could add to my watch list. Sorry, add to my portfolio. So that's one I've got that I'm sharing with you guys. I do not own it yet. It's not a recommendation. It's not a tip. Just a research idea that I've got on my watch list.
I like it.
151 on your watch list, Henry?
There we go. That'll be it. Virtually, you'll never see me again after this. I'll just be buried in annual reports.
Yes. Okay. Well, I think now, Henry, if we can, we need to talk about the issues of the weekend, Monday, and ongoing, just to give people a little bit of respite, and also to say, actually, we care about the stuff that's going on in and around us. We actually care about the groups of people, every group of individual that's been affected by what's been going on over the past week or so. And we care about those 3 individuals, those children in Southport that lost their life because of some absolute idiot, murderous, vile individual that took the life of 3 innocent kids that went to, a day group during their school holidays. You know what I mean? I've sent my daughter to some of these things in and around Leicester, mate, and she's been there for the day. And I heard that news and I was like, oh my gosh, almost brought me to tears, mate, because though for the grace of God go X, Y, and Z's relative, my aunt, my sister's kids, or relatives of yours who've got kids, or whatever, should never happen. Should never be able to go and send your child or anybody somewhere and then never see them alive again. But the reaction to it of the community of Southport is completely different to the individuals that have used that as an opportunity to go out there to cause absolute mayhem.
Yeah. Yeah, I agree with you, Peter, 100%. I mean, what happened in Southport, I don't think there's anybody on the face of the planet that would ever say that that's the sort of thing that should happen in any society on any bit of the planet anywhere. For that to happen is disgusting, frankly. The circumstances surrounding it are dreadful. I feel horrifically sorry for the parents. I feel horrifically sorry for the poor dance teacher who tried to protect the children, for the man that jumped out of a van and fought with the man, got stabbed in the leg and still couldn't stop him. You know, and I feel sorry for the emergency services that had to deal with the aftermath of it.
Absolutely.
Having said that, that situation has now sparked what is, I believe, now day 7 of riots across the country, where we've got people rampaging, to all intents and purposes, around town centres. We've had a mob attack a hotel and try to burn it to the ground with people inside. We've had people dragged out of cars and beaten. We've had people in the middle of the street attacked with hammers, with machetes, with knives, with planks of wood. We've had shops broken into. This is just barbarous behaviour, the whole lot of it. We've had hundreds of police officers injured trying to stop the violence. All I'm going to say on the topic, other than the fact that the violence is wrong, all violence is wrong, is that I've heard a lot of opinions about what's been going on last week. Everybody that I know has got an opinion. It's hard not to have an opinion, but opinions are really, really cheap. And I just want to remind people of something that happened in 1938. It was called Kristallnacht, or the Night of Broken Glass. And it happened in Germany, when a pogrom was carried out against Jews by the Nazi Party's paramilitary forces, along with participation from the Hitler Youth, including children as young as the age of 15, and German civilians throughout Nazi Germany on the 9th to the 10th of November 1938. The German authorities looked on without intervening. The world looked on without intervening, as one of the worst civilian disasters happened. The name Kristallnacht comes from the shards of broken glass that littered the streets after the windows of Jewish-owned stores, buildings and synagogues were smashed. The pretext for the attacks was the assassination of a German diplomat by a 17-year-old German-born Polish Jew living in Paris. During that night, Jewish homes, hospitals and schools were ransacked as attackers demolished buildings with sledgehammers. Rioters destroyed 267 synagogues and over 7,000 Jewish businesses were damaged or destroyed, and 30,000 Jewish men were arrested and incarcerated in concentration camps. It was reported that no event in the history of German Jews between 1933 and 1945 was so widely reported as it was happening, and yet nothing was done to stop it. Now, the reason that I've mentioned this today is because we are not that far away in England from this happening in this country. There are violent mobs roaming the streets and attacking people. So just
from
think
both sides,
very
from both sides, Henry. From both sides.
On both sides. I'm not going to say it's not both sides. But just think, I would ask all of our audience, to everybody that's listening to this podcast, just think very, very carefully about what you are saying and what you are encouraging people to do, because the end result of encouraging violence against other people is that. Thousands of people attacked and murdered across a continent for years. When you demonize people because of their religion or because of their skin color or because of their socioeconomic class, when you call them the enemies of the people, the enemies of the state, the enemies of your family, the enemies of your community, this is what you encourage. It's wrong. The violence is wrong and it's got to stop. So I just ask that everybody listening to this podcast think very carefully about what they share on social media and how they discuss this topic. I won't say much more than that, other than to say that I hope if anybody is feeling unsafe at the moment, that they reach out and that they can get the help that they need, because this is not what Britain stands for.
Right, very well said, mate. Very well said. I've seen scores of people discussing this, some good, some bad, some indifferent. Some people have surprised me, in fact, and I've chosen not to engage with it on Twitter, and I've just chosen to unfollow several accounts. I've chosen to keep my Twitter X timeline for individuals that I've followed, that I follow only. I've blocked. I've unfollowed scores of people. I've dealt with, I think, on top about 30 people that have been in my DMs, showing me stuff, telling me about stuff, arguing with stuff, debating stuff, for and against as to why it's going on. And I've tried to be objective as possible. The only thing I'm going to add to this conversation, Henry, and you've said what you've said brilliantly about the night of broken glass. My daughter was studying it about a year or so ago, and it comes from an English writer and philosopher, and his name is Aldous Huxley, spelled Aldous. And this is the way I look at things, and we have to be mindful of who is playing us all and who is profiteering from all of these situations, who is driving round in a chauffeur-driven Bentley, flying around the world, having holidays at our expense, while we're all here scared for our young ones, our family, our extended family, and our friends, and our wives and daughters and sons, etc. And he wrote this many years ago, and it's so right today. And he wrote this: propagandists propose is to make one set of people forget that certain other sets of people are human. Just think about that. Think about that, right? The purpose is to make one set of people forget that certain other sets of people are not human. Yeah? There are individuals out there running around with guns and machetes. There's another group of people out there running around with guns, knives, and so on and so forth. No one values life. What happens? We'll lose more and more of them.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Right. Enough of that. If you've not all switched off, let's carry on talking about better things, right? Sure, some of you have watched the Olympic Games, distract yourself with that, right? We've had some amazing performances. At the moment, England have been winning some goals. You know what? A couple of weeks ago, some of those Muslims, some of those racists out there were cheering on a football team in the final of the European Cup, European Championships, right? Half of that team was white, half of that team was black. The whole of the UK came together. The Olympics are going on right now. There are people, Muslim and racist, right, that are cheering on the Olympic team, which is a whole plethora of different cultures all under one flag. Yeah? Maybe we should think about more of that, more unity and less division. Yeah? Don't have to pick a side. just pick the flag that we're all underneath here, yeah, which is the flag of Great Britain. Right, Henry, give us a stock, mate. I've got one more I'm going to share with you. We've been here for a long time. It's another marathon.
Well, it's hard to go back to investing after that one, but for the benefit of our audience,
we need growth, mate, and Rachel Reeves needs growth. Otherwise, we're all stuffed. So let's just talk about a couple of stocks.
So,
come on.
There are two companies I want to talk about, both of which are on my watch list. I'm not going to go through all 150, so don't panic.
Thank heavens for that.
They are the US correspondent is back, ladies and gentlemen. You'll be pleased to hear.
Give us your best shot.
So the first company I want to talk about is Visa. The ticker is V. It's on the New York Stock Exchange. Okay. If you don't know what it is, it's a global payments technology business that operates in more than 200 countries around the world. Income of $35 billion a year. They've grown earnings per share from 481 pence to 916 pence over the last 4 years. Wow. They hit a high of $270 a share back in the spring, and then they've come off the boil because the markets are a little bit concerned about, what's going to happen. Are we going to hit a recession? Is the US overcooked? Where are we going? And this is quite an expensive business. But the shares have been on a huge tear. I mean, they've gone up from $150 in 2019 to nearly, $270 earlier this year before falling back a bit. And this is a business I've wanted to own since I can't even tell you when. And I've watched it as it's skyrocketed. And I think this year, the next 6 months, I could be taking a position in Visa. I really like it as a business. It's a key part of the global payments platform. Look on the average card in the UK. They've all got the little Visa symbol on them. Nearly all of them. I mean, the other big one is MasterCard, of course, but I don't see that as often over here. But that's the business I quite like. And I think, with it coming off the boil, that's one that some of our audience might like to go away and do a bit of research on.
High quality company, mega cap company, Henry. There's not, like you say, MasterCard's up there next to it as a bit of a duopoly. Massive company, mate. Trying to have a look at where the PE is. 23, 24, average of 28.
I mean, you've also, it's got some serious tailwinds behind it. I mean, there's this ongoing shift from cash to card that's been going on now for decades, and it's accelerating. Visa, they're the biggest card network in the world. They handle something like $14-15 trillion of payment volume in a year. There's a vast amount of data that they're getting.
The thing that impresses me about this company, always has been, is the fact that everyone's said that we need to break this duopoly because the margins on their
This Twin Peaks Investing Podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Margins are looking, they're estimating could be going up to more than 55%. A margin of 55%.
Yeah.
For a company that's, I don't know what size it is, it's
55 pence of every pound is profit.
That is staggering.
It's fantastic. It's absolutely fantastic, and it's there.
My concern would be who eventually comes and breaks into that duopoly. That's my concern. I don't know of anybody that's out there that's chipping away at that with any significance at the moment. This is why I'm going to talk about another stock in a minute that everyone's concerned about. It's getting chipped away at. But yeah, staggering. What would be your trigger then, Henry? You said from 150 to 270. What's the price now?
It's 257 at the minute, and I'm taking.
So what would it need to be for you to go?
Well, I've not got a price target, but I'm watching the chart like a hawk. So I'm looking.
Some technicals. Stealth Serve, Jason Stealth Serve. I'm going to shout Jason Stealth Serve. He'll be proud of you, mate. You're watching the technicals now, having done the fundamentals. Good man.
If Jace wants to do me a chart and tell me where the next level ought to be, that would be really helpful.
Where the wiggly line is. Absolutely.
Yeah.
Right. I'm going to talk about a stock now. I do not own it, folks. Going to pull up some data here on it. It is on my watch list. It is coming nearer and nearer and nearer. We've been having Henry and I were having a conversation. I thought I'm not letting on to him that it's on my watch list, but I will tell him now he's he's a regular listener. So I'll say hello to at Gallon73, having a conversation. He pointed it out to myself and Henry about Rightmove, and he had some concerns about Rightmove because at the moment you've got CoStar and on the market eating into their share apparently. And his comments were, Rightmove is now reporting that they're already losing market share to CoStar and on the market. The moat is narrowing now. Rightmove to be avoided now, surely? Question mark. And with a funny gift saying, seriously, don't call me Shirley, which I thought was quite funny as well. So, I mean, you commented on it, Henry, before I did. And you were saying, yeah, very well spotted. We'll need something we need to get. Good spot, Gallon. It's hard to break the network effects, which is what you've always talked about. But if you can, then there is very little truly unique about RMV, in my opinion. It is going to be difficult to break through, though, right? And I just asked Gallon, are you holding the share? The headline of lower average user revenues is the metric I've been watching. This could be impacted further if, big capital if, CoStar and On the Money can add to their market share. 1 year total annualized returns for Rightmove is -7. So it's one of the first, probably the first in a while. We've had a total returns at the moment of -7. Over the last 10 years, total annualized has been 10.1%. Compounding that over 7 years, you've doubled your money. Compounding it over 10 years, you're up 130% or more, yeah, on it. So I'm of the view that it's not over yet for Rightmove. I'm looking at the metrics and just pull up the metrics here. Find the right one. Let's see if we've got the right one here. Yeah. So at the moment, forward PE of 20.1, 3-year average 26.3. Turnover average for forecast growth 21%. Currently it's 7.1, so it's a bit lower. Pre-tax normally +3 is currently 3.9%. 3-year average is 24, so you see that come down as well. So everything's pointing to negative on here. But when you look at the quality side metrics of Rightmove, the ROCE, the ROCE, return of capital employed, is 333% still. Yeah, still quite staggering. And the average is 214 for that last 3 years. EBIT margin 71.4, 3-year average is 70.8, so still above that. I don't think people should worry about it. I don't think people should worry about CoStar or on the market. I don't think like Visa and MasterCard, I don't think they're big enough to eat away. And yes, there's complaints from certain vendors going, can you just shave that down for us? We're not making as much money. Can you reduce the contract we've got? They're still going to go to Rightmove because when you think about buying a house, selling a house, renting a house, you think, well, let me go and have a look at it's the search term for looking at property is Rightmove.
Yeah.
It's not Google, it's Rightmove.
Yeah.
Yeah. So for me, it's on my watch list. It was down 1% today at £5.08. Sub £5. I might make the right move, Henry, and make a purchase.
Oh, God.
You walked into that one, fella.
Yeah.
But yeah, on my watch list. On my watch list.
I like it. I like it. Well, I will see your Rightmove and I'll raise you another US company.
Oh, gosh. Go.
So this is, again, I imagine our audience will have heard of this, but I doubt they know just quite the breadth of what it does. The company is Moody's. The ticker is MCO on the New York Stock Exchange.
That's just, sorry, let me interrupt. For folks that listen to this podcast regularly, this is the name we use for Henry the day after he's been out with his mates playing pool. with too many drinks and sherbets having been drank. And his missus would vouch for it as well. So carry on, mate, carry on.
Thanks for that. So, along with S&P, they're a leading provider of credit ratings on fixed income securities. So they rate bonds, basically government bonds and corporate bonds. Their ratings segment includes, all types of structured finance, financial institutions, but also public finance ratings. So things like governments, quasi public sector bodies, that sort of thing. Now, their mission is to be the leading source of insight on risk. So they're not just issuing credit ratings, they're trying to help the users of those credit ratings to ascertain and measure risk. Now, navigating risk is a hugely, hugely complex endeavor. I work for an insurance broker, and I can tell you the way that the maths behind risk management, vastly complicated. I sit next to a guy who's a lecturer at a university. He's got a PhD in statistics. I watch what he does. I mean, it's mind-boggling. I mean, there I am with my abacus, and it's just embarrassing, really.
Yeah, the scientist meets the caveman. Oh gosh.
Yeah, exactly. Now, I love Moody's as a business, and I feel like I missed this one. My friend Faisal actually gave me a nudge about Moody's a while back, and I went, nah, yeah, not that interested. And the price has just soared. It's at all-time highs of $458.
Well done.
Now, we were looking at it in 2022 down at 220 and saying it looked expensive. It's pretty much been a one and a bit bagger. It's got a 20% return on capital employed. It's a very strong franchise, this. Forecast growth of 14% in revenue and 24% in earnings per share. This isn't a low quality business by any stretch of the imagination, but the price is soaring. So unlike Visa, where I'm sitting there going, well, the price has started to roll over, I might get a buying opportunity. With Moody's, I'm thinking, I could easily buy this thinking it'll keep going up and it could fall over tomorrow. So yeah. I'm waiting for a proper pullback in Moody's and just hoping it comes before the price gets to, $900 a share or something equally insane.
Yeah, there's something about stocks like that though, Henry, where, and I've done this in the past, and I tried to do a bit of it on Monday, in fairness, before I was away from the markets on Tuesday, and I'm looking at the sell-off on Friday and Monday, and I'm looking for the stocks that are at the top of their range during the sell-off and haven't budged. They've gone, yeah, you guys can carry on being chaotic. We're not bothered. And if you look at Moody's chart and think it's sitting there at the top of its range, not the whole of the Americas, but most of their stock market got absolutely smashed on Thursday, Friday, and bits of Monday, bits of early morning trading on Monday. Moody's is sitting at the top of its range. Why is that? Are they not correlated to the market? Of course they're bloody correlated to the market. So why do they differ over the past 3 days and are sitting at highs? But the other market stocks that are mega caps have been absolutely smashed to pieces. That to me is like, I need to pay more attention to that stock. Why is that one still showing that resilience and strength when others that I've talked about and lauded are down 5%, 15% over 3 days? Yeah. So the highest quality you can buy, sometimes you've got to pay up for it, Henry.
Yeah. It's the Midlands coming out in me, I'm afraid.
Yes.
I like a bargain.
Yes. We all like a bargain, mate. But just think on, right? When you bought the engagement ring and the wedding ring for your missus, you paid up for that, didn't you, mate?
Yeah, that's true. Yeah.
Bring it back, memories.
I wasn't
Sorry
down
about
at Burger King getting an onion ring.
Absolutely. And talking about a stock that did similar, Henry, today, I just put a tweet out earlier before we started. All the volatility. Yeah, we're now 30 odd years on, right? And AstraZeneca from purchase to now, today, 24 bagged and an all-time high today. Yeah. So despite what happened on Friday, despite what happened on Monday and Tuesday's volatility, it's now sitting at an all-time end of day high. So 24 bagged, buying the dips, reinvesting dividends, 24 bagged. Yeah. Despite all the mistakes I make and all the, it's just carrying my portfolio higher. Right. This stock here, Henry, I sold, right, and watched it go up, I think, 15% higher. And I was going, because there's a nice little divvy payer for me. And I sold out of it and watched it go higher. It's now below where I sold it X amount of months ago. I'm being a bit cheap in the sense of I want it to go even lower than that. And I thought it might do yesterday, and it didn't. But it's on my watch list. I've got full intentions of buying it back. And it's a stock that quite a few people hold already, and quite a few people are aware of. And the reason why it's been sold off of the past few days is because a lot of the stocks and exposure it has is tech related. Yeah. And the company's name is POLR Capital Holdings, fund manager, wealth manager. It's sitting today at £5.20, below where I sold it at X amount of months ago. I made 54%, I think, including dividends last time I sold out of it. And I just thought, you know what, the Magnificent Seven will not carry on going to where it was going. So it won't carry the share price of the group. And the Magnificent Seven carried on and took the share price to £6. And now it's rolled over. Went near to nearly £5, and I was looking at 5 or sub 5, now at 5.20. I'm going to watch it very, very carefully going forward. I'm going to buy it back again. I don't think, with regards to AI, tech stocks in general, that we're going to go back to doing things by abacus. So we're still going to need tech. How much of that's going to be AI? I don't know. How much of that's going to be Gen AI? I don't know. But tech-related stocks are going to carry on for the next 5, 10, 15, 30 years, forever after I'm gone. So that's a stock that I'm going to be purchasing. The beauty of this one is that I'm getting paid whilst I wait as well. Forecast dividend going forward is 8.8%. So I'm not buying the tech, but I'm getting the yield. Current market cap is 493 million. My estimations is that institutions will start buying that more so when it goes above 500 mil, because some of them have got that sort of market cap stipulation that they've got to have. So it doesn't need much to go above that. I'm hoping it dips below that to give me a buy-in. I can get the dividend of 8.8 going forward over the course of the next 9 years, double the return on my investment just by the yield. And if tech continues, I might even double the share price on it as well from £5. So, yeah, double bubble. £5 turns into 15 over the next 5, 6, 8 years. Happy days.
I love it. I mean, I should hold my hand up here. I own Polar Capital, so
I sold. Yeah. You watched it go to £6. You never told me. Didn't go, ha ha, Pete. I'm keeping mine while you've flogged off yours.
Well, I
cheaply.
don't like to gloat. Unlike some on Twitter, I don't generally do the gloating. But no, I mean.
So what do you think of the sell-off then from £6 down to where it was yesterday?
I think it's insanely cheap.
Right. Okay.
You know, I mean, I love the franchise. They've got some really differentiated funds. They're one of the only businesses. They're one of the only fund managers I know that have got such unique funds in them. Most big fund managers. I mean, I own Jupiter. I used to own Jupiter. I don't own anymore. But they own all the usual suspects. You know, a US tracker, a global tracker, a European tracker, etc., etc. Polar has got a tech fund, and it's got an insurance fund, and it's got a biotech fund, and these are all really interesting niches.
Yeah,
and they also tend to be top quartile performers in their benchmarks.
Yeah,
so they've got some good managers in there. So I'm quite happy to hold. So when you announced you were selling, I was like, "Yep, fine, crack on, mate. I'll have your shares."
Thank you, my dear friend. Oh my gosh, look at you! You can be ruthless, can't you? You're the ass hit my molly's down, and there's me now praying that it comes down a little bit. You're boosting it up. I'm thinking that's not helpful, Henry, at all. I'm just thinking, let me just get back in near the fiver. It might not
You
get
can have
there.
them back for
I might have to force
£7.
myself to buy it almost where I sold it, having missed out on one of the dividends. But yeah, I think it's a quality stock. Obviously, any sort of tech sell-off, it always gets a little bit of friction regarding it because it's got so much of a weighting towards tech. But it's just does what it does, mate. It does what it does, and I think it's a stellar company. Some great fund managers. I've interviewed quite a few of them to get inside of what they're doing and how they're choosing stuff. Yeah, it's not crazily cheap, but you've got to pay up for quality, as I said to you earlier. It's only in a forward P of 12 and a PE and a yield of 8.8. So yeah, onto a good one. Compound that over the next 17 years, and you've done all right, I think. Yeah, dividends been paid for 18 years, mate. Unbroken.
Happy days. Happy days.
Happy days, mate. Exactly. Right. I don't know about you, mate, but it's turned out to be a marathon. I've got nothing to add, but wishing people peace and love and some unity, and to show love to others and consideration to others. But though thou for the grace of God go I, with somebody else looking at me and going, or looking at Henry going, let's go and give him one. Let's go and make him a target. I don't think we need to do that to each other. I think the people that are up to no good need to be punished, full stop, irrespective of who they are, nationality wise, what they look like, what their religion is. If you've done bad, you deserve to be punished, full stop. The people that are trying to have other people do their bidding for them, don't listen to them. If you see, I'm not going to name the names on here, if you see that individual who is on social media telling, rousing people up to instigate them to go and incite them to do that, ask the question, where are they? They're nowhere near it. It's just lighting the torch to fan the flames, and they're sitting back on holiday, driving around in their Bentleys, doing sweet FA.
And look at the evidence of your own two eyes as well. That's another thing I would say to people, because social media, the news, the BBC, the Guardian, the Telegraph, they have all got their own take on things, because you can't cover everything, right, in a news article. So just before you go out there waving a news article around that you've spent 30 seconds reading and going and gathering up more and showing people one side of an argument, just be aware the world's a complex place and there's probably more to the story than you thought.
Absolutely.
And also consider what you're asking people to do with that information, because if your answer to something that you've read in the paper that you don't like is to go and attack somebody that looks the same way as the people in the story you just read, that's not right, and that's not right. Yeah.
Anger and rage very rarely solves anything, which is why it's nice to see some people from different cultures having debates and sitting down and sharing a meal. I think you sent me something about somebody sitting down, having a debate, sharing soup or some food.
There was a great story. There was one of these mosques in Manchester or Birmingham or somewhere. The rioters are outside. They're going to burn the place to the ground. There's like 30 police outside trying to stop them, and one of the guys in the mosques goes, I'm going to go and talk to them. And everybody's saying, are you insane? They're going to hang you from a street lamp. No, I'm going to go and talk to them. So he goes out to the riot line and he starts talking to them, and he says to the first guy, what are you doing here? And the guy says, I hate the fact we've got so many immigrants. They're all coming over on boats. I didn't come over on a boat. I was born here. Are you angry at me? No. Goes to the next guy. Why are you here? Well, I'm fed up of foreigners taking our jobs. Well, I've not got your job. What do you do for work? I work in the construction industry. Right? Well, I've not taken your job. So why are you angry at me? Why are you trying to burn my mosque down? I don't know. And these two guys are then standing there going, actually, what are we doing here? Goes to the third one along the line.
Oh, boy.
What are you doing here? Oh, I'm so angry. I've not eaten all day. I'm absolutely exhausted. I'm fed up of all these foreigners turning up. So, well, you sound like you're hungry. Do you want some food? What? Yeah, do you want some food? You sound like you're hungry. Well, actually, what do you mean? And he took them inside and he fed them. And they sat down and they talked.
Wow.
And it turned out that these people that were rioting and angry, fine, they were angry, but they were aiming it at completely the wrong thing in completely the wrong way. And once they sat down and calmed down for a little bit, they realized that they didn't need to be doing that at all. And someone had whipped them up to do it.
Yeah.
So just consider which side of that situation you'd like to be on when you tell your kids what you did this year. In the future, would you like to be the person bringing people in and giving them food and talking to them? Or do you want to be the one that's burning people's buildings to the ground and setting fire to hotels?
Yeah, it's powerful, mate. That's a powerful story. I, once again, will wish everyone safety, care, compassion, some peace, time for some reflection when this podcast comes out on Friday. Hopefully we'll hear from you. Hopefully you'll give us some feedback. Hopefully you'll subscribe to YouTube and you will tell us what your thoughts about this. If you're angered by anything Henry and I have said, please tell us. If you appreciate some things that Henry and I have said on this podcast that are not related to investing, please tell us. If you're happy about some of the stuff that Henry and I have said about investing on this podcast, please tell us and share it on your timeline. Add some positivity onto your timeline. Filter out the stuff you don't want to hear, the words you don't want to hear. Unfollow the accounts you don't want to see in your timeline. Stick to your own timeline. Only look at the accounts that you want to follow, so you don't get stuff on your timeline from people that you don't want to see. And if people start retweeting stuff you don't want to see, mute that account, block that account, unfollow that account. It's your timeline. There are people I've been dealing with, nearly 50 people in the past 2 weeks in my DMs that are going, I'm leaving, thinking about leaving. I'm having a pause for my account and all the rest of it. This is your account. This is your opportunity to learn about investing from the people you want to learn about investing. If you don't want loads of political diatribe on you and vitriol on your timeline, you don't have to have it. Okay, people? Take care of yourselves. Stay safe. Look after your loved ones. Henry, once again, fella, thank you ever so much. You smashed it as per usual, Peter, on this pod. And it's another marathon. Hopefully people will be with us until the very end. We wish you all the very, very best with your investing. Wish you all the very best in life for yourself and your family, and keep yourself safe. If you don't need to go into these different towns and city centres at the moment, whilst all this SHIT is going on, don't go. Go into the countryside. No one riots in the countryside, mate. No one's rioting on the green fields of England. That's it. Over and out. Take care. God bless. We'll see you in 2 weeks' time.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.